Whether you're 18 to 21 and just starting your journey on your personal finances, or you're in your mid 30s to 40s and in the prime working years, or in your retirement years, 60s plus, this video is going to be very important, possibly the most important I'm going to shoot this calendar year. This is going to be talking about the fact that the Federal Reserve is highly likely about to start its long anticipated pivot on interest rates. This pivot is going to have a dramatic effect on your personal finances, your retirement, your small business finances, whatever way you're functioning in the economy. You're about to be significantly impacted, and this information is going to be very important on you getting it in a little advance notice so you can make the moves necessary to minimize losses and to maximize any financial gain for yourself. So please stay focused throughout this video. I'm going to be giving context on the shifts that the Federal Reserve is likely to make very soon, the economic implications of it, and more importantly, what's going to happen at your bank, where your money is stationed, and even your retirement accounts or your small business accounts, whatever your capacity of function is. This is about to be very impactful for you. Before we get into that, I want to get in context on who I am so you know who you're getting this information from. I'm a career banker and financial services professional, 13 plus year veteran at the time of this recording. I have an active mortgage loan originator's license, active life insurance license, active FINRA investments license, and small business certified. Thanks small business banking, cash flow, and lending. So not only have I been advancing my own personal finances over the course of 10 plus years, but I've been in the industry as a financial services and professional and a banker for over 10 plus years. So you're getting this information from somebody who's not just done basic research, but literally works in the industry, helping people with their personal and small business finances and their retirement for a profession. So that having been stated, Federal Reserve has finally gotten to the point where it feels enough confidence to start pivoting, and the entire economy is literally salivating at this shift. What's going on is the Federal Reserve has had to make a lot of changes since COVID on interest rates and its policies in order to try to best protect the overall economy from outright collapse. It had to jack up interest rates to 2-decade-plus highs in order to buffer policies during COVID to help the economy stay afloat. So fast forwarding, interest rates were jacked up to 2-decade-plus highs, and that has put a lot of downward pressure on the economy across the board. Interest rates being higher basically slows lending, which in turn slows business and slows borrowing and slows consuming. So basically speaking, the economy was intentionally slowed down because prices were spiking. It was inflation. In order to combat inflation, the Federal Reserve, which is one of its two main mandates, had to increase interest rates in order to keep us from going into hyperinflation, potentially. Now that that has started to get to the point where it is stabilized and inflation is not jacked up as high as it once was, prices are still increasing, but not at the speed that they were. The Federal Reserve is starting to feel the confidence to do what it really wants to do, and the banking sector in particular is clamoring for it to do, and pull rates back down. What does this do to the economy? Quantitative easing is what it's called, and that process is where interest rates are pulled down and more money is allowed to flow in the economy, and the cost of borrowing is brought down. As I've said in many videos, we're in a debt-based, consumer-driven economy. That means in order for our economy to function or grow, money has to be borrowed and things have to be bought. There's a lot of mechanism in between those two, but basically speaking, that's what the economy is based off of. So what this all boils down to is the Federal Reserve is saying we finally gotten to a point, or are getting to a point, where we feel comfortable starting the process of quantitative easing and cutting interest rates. This is going to make banks borrowing money from the Federal Reserve cheaper. They're going to be able to lend it out to you on the back end for your consumer and small business finances cheaper. When that happens, more money will enter the economy, more economic activity will pick up. This is going to help stimulate the economy. This is going to subside the rising unemployment, and this is going to basically put more money in the system and more money in the hands of businesses, more money in the hands of consumers, and more buying, more consuming will take place. So the bank, the more important part of this video is the bank, where most of our money is housed and even our retirement is being managed. They are going to shift their business model. Lately, they've had to slow lending down. They've had to get a lot more precautious. They've also not been able to lend as much, and borrowers have not been able to qualify for as much lending products because they've been more expensive. That is about to change, my friends. The Federal Reserve starts to cut rates. Lending will be stimulated. Loans will be more affordable. more people will qualify for them. The other end of the spectrum, if you have been sitting in cash and deposits, that is about to be very unattractive in the near future. As the Federal Reserve pulls down rates, lending rates will come down, deposit rates will come down with it. That is the spread, generally speaking, for banks in the first place. What they pay you on deposits, they have to make a profit on lending on the other side of that. The Federal Reserve dropped rates and lending rates are typically relatively correlated, gonna come down with it. That means that they cannot pay you the same on deposits. So the era of 4 and 5+% interest rates on basic cash is about to be gone. And so what that means is if you're sitting in cash in your bank or your credit union, you need to start considering locking in the rates that you have now as long as humanly possible. As far as you can lock in a 3+, 4+, 5+% rate, you need to do so because it won't be there in 2025, 2026, and beyond if the Federal Reserve is able to continue with their policy mandate and their projections. They are projecting to cut rates for the next 2.5 years. Easy. That means that deposit rates will get less and less attractive. Depending on your financial needs, you need to sit down with your bank and any other financial institutions you're holding cash in and start to move your money around accordingly. This is about to be what's called a risk-on environment. We have been in a relatively risk-off environment. The basic premise of risk-on and risk-off is when you can get a really decent return on your money without taking much risk to do so. That means being able to stay in deposit products or really low risk bonds, stocks, or other cash equivalent products in the securities industry. Basically, very low risk products that pay really well. That has been the case for the last 2 years since 2022. We're going out of that into what's called a risk-on environment, where in order for you to get a sustainable return on your money, to beat out inflation and to get basic, decent returns, you're gonna have to get into more high-risk equities, and equivalent security products in order to get a decent return. You will no longer be able to sit in CDs, high yield savings accounts, money markets, and get those returns, or even most bonds. They will no longer be attractive. This is very important if you are in cash, if you're borrowing from the bank, or if you're in retirement phase. Your retirement positions need to be evaluated. Are you in bonds? Are you in stocks? Are you in a lot of cash? You may need to assess that if you're still looking to grow your portfolio for retirement. If you're in a situation where you're just preserving and you're sitting in cash or cash equivalents or really safe bond portfolio, just sit down with your advisor or whoever's managing your money, or if you're doing it yourself, and make sure that you're at least moving it around equivalent to decent yields in that bond portfolio, in that cash equivalent portfolio, because we're about to get into an environment where they're not going to be paying the same. So at least put your hands and eyes on it to make sure that your goals will still be met, because you may have to increase your risk level to maintain a decent return to keep on schedule for your retirement. If you are just entering the workforce, if you're a young individual, if you're under 30 and you're just getting geared up, this basically means that you are about to have the ability to borrow money at cheaper rates, and that you're about to have the ability, if you do have cash, you're going to have to start looking at more aggressive places to put your money, because savings and CDs aren't going to cut it in the moderately near future. This video is a warning to put a basic perspective without getting into a lot of high-level technical stuff. Your money is not going to earn the same in the bank for long if you're in cash. If you're looking to borrow, if you're looking to buy your first house, invest in your business, this is going to be a golden opportunity to at least have lower borrowing costs. I can't tell you that banks are going to get less stringent on their underwriting, because there's a lot of economic factors that are still unstable. You still have elections going on. We still have a lot of geopolitical risk. There's a lot going on that'll make banks continue to be a little nervous. So I'm not saying that underwriting is going to get easier, but your borrowing costs will get cheaper. So look at your economic plan, your financial plan. Look at where you're participating in the economy. Take the context that I've just given you and put it to good use. This is going to be your last warning to make the moves necessary before these rate changes are locked into place and your financial position is altered permanently. So please take this information, evaluate your finances, your personal, small business, or retirement finances, and sit down with your bank, your bankers, your advisors, and make sure that your plan is still in place, or that whatever adjustments you need to make on your plan are made, because banks' business models are about to change. Financial institutions are about to change. Retirement plans are about to change. The stock market, the real estate market, the business environment is about to change. So don't say you haven't been warned. If you caught this video, I'm giving you context. I want you to drop any comments you have down below around your financial position at this time, how you plan to make adjustments if you're already in position, if you're ahead of this change. Do you believe the Federal Reserve is going to pivot slowly, or do you think the Federal Reserve is going to slash rates at a resounding speed? Do you think the Federal Reserve is going to hold rates where they are? How is this going to affect your overall financial plan? I want you to comment your thoughts, your questions, your curiosities, concerns down below. I want you to continue to support this channel by commenting, sharing, and subscribing so this channel can continue to support and invest in you. I also want each of you to stay focused, stay in motion. I'll see y'all soon.